For the last decade, technology investors operated in a world of pure digital abstraction. Growth was a matter of writing better code and scaling software. Today, that industry is colliding with the heavy, unforgiving limits of the physical world. Artificial intelligence scaling has hit a wall of grid physics. While compute power was the story of 2024, the bottleneck for 2026 is baseload electricity. To train massive generative models, hyperscalers need gigawatts of constant, reliable power. The existing power grid cannot provide it. Right now, the PJM interconnection, which manages the electricity market where the densest data centers operate, is paralyzed. They are facing a 220 gigawatt backlog of new power generation applications stuck in administrative limbo. Even with a signed agreement, developers hit a metallurgical speed limit. Connecting a data center to the high-voltage grid requires massive step-up transformers. The global supply chain is so constrained that the lead time to procure one of these units has reached 144 weeks. The velocity of AI development is now entirely captive to the slowest-moving, most heavily regulated physical utility monopolies on the planet. Silicon Valley hyperscalers have recognized that waiting in utility queues is an existential risk. To protect their core business, tech monopolies are weaponizing their balance sheets to acquire dedicated power plants, executing a pivot toward absolute energy sovereignty. Microsoft recently made a 20-year capital commitment to underwrite Constellation Energy's resurrection of the Crane Clean Energy Center. This deal pulls 835 megawatts of carbon-free baseload directly from the shuttered 3 Mile Island nuclear site. Amazon Web Services followed with an $18 billion deployment for a 1.9 gigawatt nuclear power purchase agreement. They are buying the baseload output at the Susquehanna plant to ensure their servers never go dark. This demand shock creates a concentrated cluster of infrastructure beneficiaries. The companies commanding this supercycle are hardware suppliers like Eaton and power producers like Vistra and NextEra Energy, which is currently executing a $75 billion capital offensive. Power has become the ultimate moat. The corporations commanding the baseload fission ultimately command the future of global computation. Away from the data centers, the broader economy is struggling with its own structural break. While headline economic data shows growth, those top-line numbers are a mirage, masking a severe bifurcation. We have split into a K-shaped economy. The upper quintile of households continues to float aggregate GDP through experiential spending, shielded by compounding equity wealth and mortgages locked in below 3%. Capital allocation here weights the upper arm of that K, targeting companies like Booking Holdings for luxury travel and Amazon as a broadline value shelter for high-income shoppers. This chart reveals the reality for the bottom 80%. The U.S. personal savings rate has plummeted to a catastrophic 2.6%. Without savings, credit becomes a daily lifeline. Consequently, credit card delinquencies have hit 12.4%, and subprime auto loan distress has exceeded 6.6%, exceeding the 2008 financial crisis. You can see the corporate casualties of this squeeze in real time. Legacy department stores like Macy's are watching middle-class foot traffic vanish, leaving them trapped inside massive physical footprints and margin-destroying promotional cycles. Processed food giants like Kraft Heinz are facing a similar crisis. Volume declines as consumers reject price hikes, trading down to private labels for basic groceries. The soft landing narrative assumes the top 20% can bridge the gap for everyone else. But with 80% of the population hitting a debt ceiling, record spending from the affluent quintile cannot prevent an aggregate economic contraction. If the consumer base is fractured, the policy landscape is shattered. The post-pandemic illusion of central bank coordination has been replaced by institutional discord and asynchronous policy. The Federal Reserve leadership transition from Jerome Powell to Kevin Warsh was marked by intense political friction, resulting in a narrow 5-4-4-5 Senate confirmation vote. Inside the building, the once reliable consensus has collapsed. We are seeing historic four-way dissents and public rhetoric from hawkish members, warning that current policy is not restraining the economy, but they are operating in an environment of fiscal dominance. The U.S. government is running a structural budget deficit of $1.9 trillion, and the net interest expense is consuming $1.0 trillion annually. This creates a mathematical trap. The Treasury's insatiable demand for capital crowds out private credit, leaving central banks with very little room to stimulate the economy without risking a sovereign crisis. We are watching the velocity of real yields, specifically the 10-year TIPS. It has pushed to a devastating 2.17%. This elevated cost of capital acts as a sorting mechanism across corporate balance sheets, favoring self-financing titans while penalizing those reliant on debt. Cash-rich winners like JP Chase and Apollo Global Management are thriving on this high-rate environment. On the losing side, entities trapped behind the 2026 refinancing wall, like vulnerable regional banks and legacy office REITs, are facing an existential liquidity crisis. This pressure is mounting just as the West enforces a cascade of 100% tariffs against Chinese manufacturing overcapacity, forcing a sudden inflationary re-onshoring of supply chains. We are seeing the physical friction of deglobalization. Decades of seamless trade are ending as supply chains are forcibly wrenched back within sovereign borders. Navigating this macro regime means pivoting away from zero-interest abstraction. Success now depends on owning structurally essential, geographically secure physical assets that can withstand the cost of capital.